Hello and welcome back to Miss White's Grade 11 College course. We are talking about 9.2 today, investment alternatives. There are quite a few investment alternatives that exist in the world. We're only going to talk about two today. We have to think about the kind of risks and rewards that you want when you are doing an investment. So this is a little bit of an investigation of that, okay? So example A, a mutual fund has an average annual rate of return of 12.45%. They charge 2% per year as a fee, which is pretty standard. Suppose $1,000 is invested for 3 years. Calculate the approximate value of the investment, assuming annual compounding. So what is a mutual fund? Well, it's a type of investment where people pool their money together to buy stocks, bonds, and other assets. Now, that doesn't mean you have to know those people, okay? You would just go to the investment company or the bank or whatever, and you would say, I want to buy into a mutual fund. And so they would take your money and put it together with other people's money in order to buy stocks. And that way, you're able to buy parts of stocks, and you can have a little bit more diversity in your portfolio rather than just buying your own stocks by yourself. And somebody will manage that for you. So hopefully, if that person is very good, then you'll get a good rate of return. Now, if they're not very good, then you can really lose a lot of money, or if the stock market isn't doing very well. So you do have to really investigate those companies and make sure that those mutual funds are doing very well. You want to ask them if they have what their 5-year return is, 10-year return is, right? And you want to make sure that it's a sort of an older mutual fund that's been well established. You don't want to go into something brand new and just just go with whatever, go with the flow. You want to make sure that that is a good mutual fund, okay? So in this case, we do have quite a good mutual fund. The average rate of return is 12.45%. That's a lot higher than a bank. A bank is usually like 2%, 3%. So we're talking about a much higher rate of return, but they're also charging you a fee. So you want to make sure that that is going to be covered, okay? Now this is going to be compounding. So again, we're always going to use A equals, oops, I did not put my pen in. I did. A equals P times 1 plus I to the N, right? And in this case, our principal is 1,000. Our interest rate is going to be 0.1245 minus the 2%. So it's actually 10%, 10.45%. And the number of compounding periods is 3 because we're doing it annually and they're 3 years. Okay, so I'll just fill that in to our formula, 1,000 times 1.1045 to the 3. Type that into your calculator. And you will get 13.47 and 40 cents. Okay, so that's the value of the investment after 3 years. Now, it's called an approximate value of the investment because, of course, we don't know the future, so we can't predict how well the mutual fund is going to do. Just because it used to have an average annual rate of return of 12.45% doesn't mean that it will in the future have the same rate of return, depending on how the stock market goes and everything. It could go up, it could go down. So that's just the, predicted value of investment, but it could be different, okay? So we're going to look at a different mutual fund now. A mutual fund has an average annual rate of return of negative 5.29%. So this one is not managed as well, or maybe they had some really bad luck, and so they actually are losing money. If the investment company fees are 2% per year, calculate the approximate value of $1,000 after 2 years. Now, even if they are losing money, they're still going to charge you a fee. So you just have to be aware of that, right? They're not going to just be like, oh, we lost money, so we will do it for free for you. That's not how it works, okay? So again, my P is 1,000. My I is negative 0.0529. And I'm subtracting off my 2% as well. So that gives me negative 0.0729. And we're only going to go for 2 years instead of 3 years this time. So again, I'm using my A equals P times 1 plus I to the N. And I'm going to fill it in with the numbers. When mine is 0.0729, oops, missed my 2, squared. And you type that into your calculator, you get $859.51. So you can see that we end up with less money than we started with because, of course, we're losing money. So that's how that works, okay? Example C. Now we're going to talk about a different type of investment. This type is where you invest money on a frequent basis. So usually if you have a mutual fund or a bond or a GIC or something like that, you're going to put the money in and you're not going to touch it for a while. Okay, so that's why it just earns regular compound interest. In example C, it says, suppose you invest $200 per month from age 16 until your retirement at age 65. Assume the investment averages a 7% annual rate of return compounded monthly. How much will you have upon retirement? So you're putting $200 per month. That means you keep adding money and adding money and adding money. So we're not going to be able to use A equals P times 1 plus I to the N because that only works if we're leaving the money alone. But in this case, we keep adding to it. So we have to use a more complicated formula. Now, usually if you are in Canada, which we are, and I'm sorry if you're not Canadian, but we have what's called an RRSP, the Registered Retirement Savings Plan, and it's set up to provide you an income after retirement. So the government is trying to encourage us to save money for our retirement so that, people aren't like homeless and stuff or, super hungry when they retire and stop working. So what happens is you're allowed to put money into the RSP and you claim a deduction on that for your income tax that year. So if I put $1,000 in, I can claim a deduction of $1,000 on my income tax. And so, they won't give you back $1,000, but they will give you a tax break. Okay. When you put that money in, it earns interest and that interest is tax-free. But when you retire and you start taking money back out, they're going to charge you income tax on the money. Okay, so that's why they don't charge you taxes in the beginning because they're going to charge you taxes when you start taking the money out. So that's how an RRSP works, and that's what people usually use in Canada when we want to save for our retirement. And it would be a really, really great idea if you would start saving for your retirement now, even though you're only 16 or 17 or 18 or however old you are. And retirement age is usually 65 or maybe a little bit younger, or maybe a little bit older. And it seems like it's a really, really long time away. You can make a lot of money this way. Okay. And so we're going to look at how much money we are going to earn from that. And so let's think about the amount of time. So that is going to be 65 minus 16 years, which is 49 years. Okay. And the formula for this is quite complicated, but fortunately we do have the internet at our disposal. So I'm going to look up annuities. Now that's what it's called, an annuity. An annuity happens when you keep putting money in or you keep taking money out. Okay, so we want to find an annuity calculator. So I'm just going to type it straight into my search engine, annuity calculator. And you can see that there are all sorts of different resources here, right? Like you have different banks, and then we've got the Canada website. Maybe we'll try the Canada website. I haven't tried this yet, so let's see if it's good. It's just explaining what a type of what an annuity is and what the types are. I don't know if it has a calculator. So, if you're interested in doing this kind of thing, you can go search on your own. I'm going to go back to the one that I've used before, which is this one. Now it says annuity payout calculator. Now remember the question said we are paying into an account. We're not getting paid out, right? See, it says you can withdraw money. That's not the type of calculator we're looking for. Okay, so you have to think about what type of calculator you want. In this case, an annuity payout calculator is not what we wanted. So I'm going to try clicking this annuity calculator. And you can see, oh yeah, it starts with money, and I'm going to put money in, and then it has an interest rate, and it's going to calculate after a certain number of years. So that's the type I want. I'm not starting with any money, and I'm not putting money in annually. I'm actually only going to put money in monthly. So we're going to put money in the beginning of every month. So that's why it says beginning annuity due. You can put it in at the end of every month if you want. And it's going to be at 7% because that's what the question said. And we're going for 49 years from the age of 16 to 65. So let's calculate. And that's it. It tells you what your end balance is going to be. So our end balance is $943,730.03, which is a really, really good, because it says your total principal, that's the total amount that you have put in from the ages of 16 to 65, $200 a month. The total amount that you put in that way is only $118,000. And all the rest of that money, the extra $800,000, comes from interest. So you earned $800,000 in interest, which is like more than 4 times the amount of money you put in, which is pretty great. Okay, so that's why we want to encourage you guys to start saving now and do an annuity so that you can really have lots of money when you retire. And it can be a really good investment for your future. And it's a lot less risky than doing a mutual fund or something like that. So that would be one way to calculate your annuities. Just go online, look for an annuity calculator, and it can find you information. It'll give you a chart, a graph, and it'll give you a schedule that tells you how much money you had at exactly however many years or months, right? So you can see all the money if you want to, and how much interest as well that you've earned. Okay, so that's how you can do it. So the takeaway is, there are lots of different types of investments that you can have. The more risk you have, the bigger the payout is usually, but you have to worry about risk. Okay, you can't just assume that you're going to make money if you go into the stock market, or if you go into a mutual fund, you're 100% going to make money. So a bank has a lot less interest, like a lot less payout, but it has a much lower risk, right? Whereas a mutual fund is a little bit higher of a risk, a higher payout, or if you go into day trading or something like that, those can have very high payouts with very high risk. Okay, so you could lose a lot of money. And it's not a bad idea, even if you do have some stocks or something like that, to also, use the tools that the government has given us, like RRSPs, and save money that way. Okay, so I hope that was helpful to you, and I will see you later.